Hey, how you doing, everybody? This is Scott Kidd, Yacht Captain Investor Podcast. I'm here today with Glen Sutherland, a Canadian investing in the United States. How you doing today, Glen?
I'm doing great. Yeah, good day.
Yeah, it is a good day. It's beautiful weather out today. I know it is in Florida. I imagine it's not bad for you guys either.
It's not that bad. I don't know what part of Florida you're in, but I saw you guys had a lot of snow almost as much. I think some parts had more than we had in Canada.
Yeah, there was the Panhandle up north, and that's fairly rare anyway for Florida. But
I know. I know. It's a one-off.
Yeah. It's been kind of weird weather anyway. But
yeah.
For people that don't know you, just tell them a little bit about yourself.
Yeah, sure. So before everybody tunes out, I invest in the United States. I buy lots and lots of single-family houses, duplexes, fourplexes. I got a couple 100+ unit buildings. A little bit of everything. I like to buy traditional purchases. Typically, I renovate everything, not because it's I want it to be like some sort of pristine sort of thing, but typically I buy stuff with problems. We buy stuff, we reno it. We do subject twos, we do contracts for deeds, we do seller financing. We do whatever it takes to get the property, raise money, joint ventures, and then I do it from afar. If you live in the United States and you're like, hey, I don't think I could do this in the next state over, I'm doing it from a completely different country, and I managed to do lots of them, and I don't need to go on site. I don't need to do this. You just need to build your team properly in order to be able to run it from a distance.
Yeah, it's amazing to me. I mean, I was very apprehensive at investing out of state and stuff first, and then I heard about a lot of people investing from other countries and other things. I thought, well, if they're doing that, then I should be able to at least take a swing at it. I mean, just for what's some type of a tip you could advise people that are like foreign nationals, because I work on yachts, and there's a lot of people that I work with are foreign nationals that don't think they can invest in the United States by being a foreign national.
Yeah, well, a lot of times whenever I'm doing a sales call or anything, people I usually just ask them why do you want to do this? Because if you're not clear on why you're doing it and you're just doing it for the heck of just investing in a different country, then what's the point? People will brag about all the things they've done in their current country, and you just go, well, then why are we having this conversation if it's doing so well? Why are you doing this? So a lot of it is, I think, it's define this, figure out why you're doing this in the US. There is a ton of reasons to go do this in the US. Depends on where you live too. It also could be a reason to just do it in a different state. For instance, I live in Ontario, which we don't have good tenancy laws. So if you say lived in, New Jersey or, one of these places with rent control, California, you might say, hey, I want to just invest in a different state, right? Because I want to be able to do evictions. I want to be able to do rent raises on lease renewals, right? I just don't want to deal with all the rent control situation, right? I think it's figuring out why. Do you want to be paid in US dollars? Right now, what Trump is doing, he's, at least for Canada, he's putting a lot of pressure on it, and Canada's kind of, they're lowering interest rates and everything, so it's going to boost inflation, which drops the dollars. I personally would rather be paid in US dollars because it's going to push the Canadian dollar down. That way, whenever you get paid, you're getting an extra bump on your money, right? Every dollar that comes in, it's worth a lot more, right?
You're invested in real estate that's in US dollars. You're hedging a little bit against inflation as well, so you get kind of a double benefit.
And it's one of those things, a lot of people are like, oh, am I really going to go buy in the US when it, right now, it's about $1.44 extra. So $1 US is $1.44 Canadian, right? So it's going to cost you want to buy, a house, it's going to cost you basically 44% extra buying it as a Canadian. And people are like, does this even make sense to do this right now? But the thing is, if you're doing this right, you're not going to be like, I'll make the EC numbers. I'm not going to put $100,000 in and pull $100,000 back. You're building something that's going to be worth more money. So you're putting $100,000 in, but then ideally you're going to generate a cash flow from this. And someday you'll get that money back plus a lot more money. And, someday could be really quick depending on what strategy you're doing, right? You could be just doing a burr and getting your money back in 6 months when you hit your past that period. Anyway, there's a lot of opportunity to do this, and I think everyone can find an excuse why not to do it. There is a million excuses to do it, right? And I think it's there's just a lot of availability to public records in the United States that just isn't available in a lot of other countries, which I think a lot of Americans don't realize. Right now, I could go on the internet, I could log into one of my apps, and I could figure out what a house is worth, what they bought it for, what the current mortgage on the property is, what the owner's address, phone number is, and I could contact them. You want to do that in Canada, it's not as easy. It's not public records. They have too much privacy laws. Yeah, privacy laws which protect all that. Even if you go to Zillow.com in the US versus Zillow.ca in Canada, it doesn't list the last sale price because it's private. You want to be able to negotiate well. You want to know, you want to sit down to the call and have a bunch of the pieces prices already. Like,
Mm-hmm.
like, hey, I see what they got this mortgage registered for, and they did it like, this, 10 years ago. You can look up what the average mortgage would be. Like, at least I don't have an app that'll tell me what their interest rate is. You get an idea if it's even something you want to take over as a sub to, and so you can kind of like scratch out certain properties or certain strategies. You're like, hey, if I'm going to talk to the seller and try and take this property down, a bunch of these strategies just might not make any sense. So like that's a huge advantage. Like you're not going into these calls blind. You can come in with some information, which is a huge advantage.
I would add also another huge advantage in the United States is the access to capital markets and the way that the debt structure is. They make it easy for you to be able to take on leverage for properties and stuff, especially as an investor. There's also a lot of other tax
financing,
strategies.
right?
Yeah.
The lenders want to lend money, which is sounds obvious, but it isn't obvious. Like you go to Canada, they do want to lend money, but the thing is, it's going to be all based on you, right? You're trying to buy a rental property, and the loan is based on if my income, like from my T4 or W2, if my income can support the rent if the tenant doesn't pay. And you're like, well, it's a business transaction. It should be, can the property support
support it? Yeah.
Yeah.
That's
so
what's
it's a
great.
different state, right? Different state of mind.
Yeah, that's what's great about those DSCR loans and stuff like that, where it's based on the income of the property, not on the individual, which is great for investments. And we have opportunity zones and, we have, tax abatements for certain areas, which I think with it just being a lack of housing coming up, they're going to increase the population density of build per acre, units per acre. We're seeing it already in Florida with the Live Local Florida, where they've increased the density because a certain segment of it has to be affordable housing, which I don't exactly, it's not too clear on how that's all going to work out, but that just happened sometime right around 6-8 months ago. And I think there's a lot of those things that are going to be happening throughout the U.S. And have you seen anything like that you're taking advantage of or any?
Well, what we're looking at right now, which I used to do a lot of these back in like 2019, 2020, like before the COVID times, but is the short sales and the foreclosures. If you look at the inventory, you just go to HUD.com, you can see that there is like inventory there's tons. Like there's tons of opportunity. The banks are open to selling these at a good price. That's one of the opportunities I'm looking at. Like the tax deed auctions, like there's lots of opportunities.
Yeah.
Right?
Anytime
there's it's always a different thing. People will focus on the bad stuff, like the interest rates are higher, but you can get the property cheaper. So when you look at your monthly payment, it's still the same.
Yeah, but I say this to people a lot. Like they say, you're not concerned about the interest rates. I said, no, not really. I mean, because for me, it's all about, can I make this property cash flow to where the interest rates don't matter? If I can't, then I need to move to a different property or maybe think of a different strategy or buy at a lower price point or cost basis to make that happen. And it's about making it work. The interest rates are just a single part of it. Like how much money I'm going to have to put into the property, how much is it going to cost to carry this while it's under rehab, what's going to be the return, do we have enough reserves to cover that, and and everything like that. It's a typical business strategy. If it doesn't work, then or can I get it for a seller finance deal or something like that, where I can get a lower rate and maybe pay a little more for the property. You seem to do that quite a lot, so you probably look at a whole different realms, and you probably have a lot of different tools in your tool belt to kind of go through that and try to make those deals work. It's about making the deal work, I would say.
Well, yeah, and some of it's about the tools, but a lot of it is just about the deal flow. Like if you buying every property you look at, you're paying way too much, right?
Yeah.
You got to go through a bunch of deals, and it's a lot of it is just getting that flow coming to you, even if you're out of state, out of country, whatever. It's there's no excuse. There's tons of places. There's just marketplace. There's bigger pockets. There's like hundreds of places. Just getting on a ton of wholesalers lists. Talking to mortgage brokers if you're buying bigger stuff. Talking to real estate agents, getting all their expired listings. There's just getting the flow coming in, right? Whatever you're looking to buy is just getting as many of those coming into your inbox all the time, because you're going to make better buys if you're looking at a lot of properties.
Yeah, I think if you look at as many as you need to look at, you'll find something to buy, and then the next thing is if you don't have it at a certain point, you're going to run out of capital. It's finding the capital. But if you let people know that what you're doing, and they see you're being successful and you're genuine, you keep growing, people will invest in your deals, and they want to come along. They may not want to do what you're doing. People say they want to do, I want to invest in real real estate and do what you're doing, but then they find out a lot of times they don't want to do the active part. They want to get the returns, they want to get the passive. So, so maybe they should invest in syndications or invest directly in your deals, in your fund, in your thing. Basically, they're investing in you,
Yeah, people get to know you over time, and then some of them want to do coaching, some of them want to do all this stuff, and then some of them realize that if they do coaching, that they realize there's a lot of steps to this, and this is a lot of work. And those people are the ones that are primed to be a joint venture, a private money lender, syndicated like LP partner. Those are the there's still opportunity for them to invest. It just you just have to figure out what they're actually interested in. But if the thing is, if you've taught them everything then they're going to learn to trust you. They're going to see how sincere you are, and they're going to understand how your business works, right? They know how you're going to pivot if stuff happens, like what
and they know when things happen and things, you're going to communicate to them and tell them, hey, this is going on. We're going to have a little bit of a rough patch or whatever, and they know from dealing with you that you're going to go to the mat and you're going to push through and make it work for them, and you'll just keep going until you get it sorted, and that's the thing that I tell people over and over, is that they have to, you want to know who you're dealing with. You can't really compare it to like the stock market, because you can just pick a stock and throw the money in there, or your retirement thing and just put it in there every month and forget about it. Of course, that may not go very well, but if you don't pay attention to it, if you don't pay attention to it, you're going to probably lose it, or it won't go so well.
All of this real estate stuff, almost all the strategies, even if you do that and you just hand it over to a property manager and you forget about it, sometimes you get lucky, but I found you still have to watch those property managers. You got to look through the financials. You need to ask questions and grill them about this, and because otherwise expenses get more expensive.
and you need to do updates, not just quarterly updates. Depending on the project, you might be doing a weekly update with them, a call or a Zoom call or an email or something, and every few months going by the property and checking in with them, because I would say after vetting the sponsor, then you're looking at vetting the third party property management, or if it's in-house property manager, you need to be on top of those guys, because that will kill any property. If it's poorly managed, the residents will be unhappy, and then once the residents are unhappy, then the investors are not happy, because the residents will move out. It's another thing that I tell people all the time. It's that, and their communication with you, and letting you know what's going on. And if they communicate well, they're going to be communicating well with the property management, the other investors, all the other people involved, the finance guys, from top to bottom. It's, what would you say was your biggest challenge in getting started investing in the U.S.?
Well, there's a bunch of challenges getting started.
Well, the biggest one,
I would say it's just setting your teams up remotely. It's like sometimes can be hard to hire a contractor from a distance, hire property managers from a distance. It's building that team from a distance. You can learn the strategy, you can learn how to do this, you can learn how to underwrite. A lot of times you can do the phone calls with sellers and whoever else over the phone or over Zoom or Meetup or Google Meet or whatever you like to use, right? But setting the teams up, I think, is the hard part. And I think it's one of those pain points. If you don't do it right, it's expensive to fire them and hire somebody else. It's expensive to fire a contractor mid-project, because the second contractor, because I've done this, the second contractor is never the price of what the remaining budget is.
No, and it's always more, and it always takes longer, and no one wants to come in and restart a project that's in the middle, because they can't guarantee the quality, because they don't know what's underneath and what's happened. Then they start doing it, they almost have to do it all over. I've had contractors come in and say, nah, I'm not going to jump in on this unless I rip the whole thing out and redo it, and
they have different standards, especially if half the property's been plumbed, and then they're going to put their license on the line to pull the permit. They're like, no, we're going to re-plumb it.
It's like, oh, what about all this?
We've already done. But that's the thing, like with you're doing this remotely, you gotta act like you're the bank. Think about how a bank, if you're gonna do like a renovation or construction loan from the bank, it's gonna come in draws, right? It's gonna be you're gonna tell them what's done. They're gonna send an inspector. The inspector's gonna check the work out, and if the work is done to what they believe is code or whatever they're looking for, they're gonna release the funds to you, which you can pay the contractor. And if you mimic people who are doing it better than you or protecting their own butts better than you, you're gonna do better. You don't have to reinvent this. You just mimic someone who's doing it really exceptionally, and that's what banks do, especially usually lenders, they're not in the business of giving away money for free, right?
No,
They're in the business of making money.
yeah, they're not in the habit of losing. They want they want you to be successful and keep borrowing money from them. And they don't want the property.
No, they sure don't.
No.
When they do get them, that's when they just want them gone. That's
Yeah.
where they'll sell them for what they're into it for.
Yeah, if it's in their portfolio, because that's also what people don't realize is that counts against the amount of money that they can loan back out too. It's a liability for them being on their books, whereas liability for us is the loan, but that's actually an asset for them because it's generating money for them. Being the bank, I think that's great advice for people because you really have to watch people like a hawk. I mean, nowadays it's a little easier with all these apps and video and stuff. You make the contractors walk through with a video and take pictures of everything and put it in a drive, daily and that kind of stuff, so you can see the updates and stuff like that. And if you can have some kind of boots on the ground, or even a partner that's there. One thing that I learned was also having someone that's there that has skin in the game. It can't just be sweat equity because they might get tired of it. And if they have money in there, they're going to fight, all the way. You don't want them to fight with everybody because then you'll start to lose. Been through that too.
I know. I couldn't agree with that more. The sweat equity is what a lot of people try to negotiate into the deal, and when things don't go perfect, they're the first ones to leave.
Because they're like, well, what am I busting my butt for? In their mind, they've done everything. This person's way off there. They're not doing anything. When even though you put up the money, you organized the deal, you bought the deal, you looked at 30 other deals before that one, and everything else. And well, it's truly a team effort when you're remote. And I think it's easier these days doing it now with the apps and everything else, but in some ways it's easier to fool someone as well, if you're not completely staying on top of it. Is there any particular areas in the U.S. that you like more than others?
Well, one thing before that, but you just mentioned apps, and if you are using apps, that is a great way to do a quick check on a property and you see pencil it in, but do check it out. Like do go through the comps. Don't just like, hey, here's 3 comps and this is what we think it's worth. Open those comps up, look at what they are. I'm amazed sometimes. They're like, this is a bigger house with more bedrooms.
Yeah.
This isn't the same thing.
30 miles away. That's a whole different town, and that's
exactly.
I've seen that with a lot of the syndications you see in the pro formas and stuff where they have, someplace that's like 10 miles or so away and it's a completely different, it's not a valid comparison, but they're like, yeah, but the rents on that one are this 20 years newer. You're not going to push the rents to that one. That's a way better area. You really have to have someone there. Getting back to my question, what areas do you like? What areas do you like?
Well, I like a lot of different areas, and the other thing is that I like a lot of different strategies. So the one part that I have trouble with when people like, oh, this is the list of where I want to invest. This is the spot. Because what you're trying to do is different, right? And you're trying to put a round peg in a square hole. So it doesn't work. So like for instance, like I know you're in Florida, so down in Florida we do like Space Coast area, like the Cape Canaveral, Palm,
that's a great area.
Over in there. We do Jacksonville. We do a lot of Ohio, Dayton, Toledo, Cleveland, Detroit. We did a little bit of Kansas City, Missouri, Huntsville, Alabama, and Indianapolis, Indiana, and then I've been doing some multifamily in Texas. So it's it depends on what you're trying to do.
One of those areas has a different strategies. Like I was thinking, Midwest is Ohio especially is kind of more of a cash flow.
Yeah, exactly. Play. You get on different sort of rides with different things, right? Like you get into like the northern Alabama, and it's just there's such a low vacancy. Like there's no homes compared to the amount of businesses and high-paying jobs that are there. There's just nowhere for people to live. So you'll like even when the market going down like the last 2 years, it's still going up because there's just nowhere for someone to live. So you get those perks, and then you like Florida, it's like the cash flow is not going to be as good as like working in that kind of. But like the flips, the vacation rentals, there's just a different thing that works there, right? People can still like, don't get me wrong, you can still go do a long-term rental in Florida, but it's you just might not be getting I don't buy on this, but if you're looking at like that 1% rule, which is your rent to value ratio.
Pretty tight. I haven't done it in Florida just because of those taxes and insurance, but I do have friends that do.
Well, the insurance.
We with our 13 unit a couple of years ago, they renewed our insurance, but they did not renew our wind and storm. So we had to get another rider. We had to get Citizens, which is the government insurance for the whole thing, which is we got insurance but no wind and storm. That that's the whole reason you have insurance.
Yeah, that's what's going to hit you in Florida.
Yeah.
We
And
have a property over in Tampa Bay area, and I think that storm that went through just like destroyed the roofs.
oh man, yeah, that's a tough thing. But it's, you know, it's the expense of, it's just part of living in Florida. And I don't think the storms are going to get any easier, or, you know, that's not
I
going to
honestly
go
don't know how
away.
insurance even pulls it off, right? Like, because you know, every bunch of years you're gonna basically do
Yeah,
a
yeah.
claim, and you're like,
Well, a lot of them have moved out, you know, a lot of them have moved out, and they've been collecting claims for a long time. And the way their strategy is for paying out is quite unique. You know, they try to stall you out and try not to pay out, you know, so until you just settle and take the money, you know, whatever it is. But it's, you know, we'll see, you know, like with the fires in California and stuff too, that's going to be a tough one too, you know. So nationwide, I think, you know, rates are going to probably correct and go up a little bit more.
Inflation's going up. It's just gonna
Everything's going to go up, you know, and at a certain point, that's why people are moving out, you know, moving from the less dense areas in Florida to less dense, so the rates are better. I mean, we moved a couple hours north, and the cost of living, just insurance and taxes and everything else, was a third of what we were paying further south. So it's all relative. That goes in, you play that into your strategy, I would imagine.
Oh yeah, it's all like with all of this stuff, it's numbers game. I took some students down to Ohio last summer, and we were going to the property, and I'm walking down the road, I'm like, I think it's this one. Just a sec, let me get the number again. And then they're like, wait, you don't know which house is yours? I'm like, I've never seen these before. And I'm like, you guys wanted to do a property tour. I don't think you don't need a property tour. You need someone on your team that can walk the property that you trust, right?
Yeah.
You need to work the numbers. It's a numbers thing, you know. If you're in Florida, make sure you have your wind coverage. You just make sure you have the right things for where you are, right? In your insurance and in your go through all the parts. Like, hey, if you're gonna have extra vacancy, plan that in. If you're gonna for some markets, right? Some of those cash flow markets have a higher vacancy rate. Plan it all in. And if the numbers check, you got something, right?
Yeah,
someone's checked it on physically in person. You know, your lender has checked the numbers. You've had maybe a broker, a realtor try to check if you're gonna planning on doing your exit strategy. I do it all myself. I have someone else check my work because I make mistakes.
You miss stuff from time to time, you know, and you know, I would never go by what the pro forma says or what the broker sends you.
Especially the selling broker, no.
Yeah, the selling broker, just plan on that being, you know, within 50% of what your numbers are. That might be a little generous, but
That's
you know,
little general.
Yeah, I know. I can't say that, but you know, with the multifamily, a lot of times we were seeing this a lot, especially in South Florida, where they were basing the price, because it's all based on net operating income, cap rates and everything, so that the projected rents were establishing the price. Like, they were selling it based on the projected price of the rents and everything. So the price was higher. It's like, well, you know, I got so many times they're like, well, you know, you can come in and raise the rents and do this. And I said, well,
I'm not
if
buying
it's
it
that
for that
easy,
price. I'm buying it for what it is.
if it's that easy, why aren't they doing that now?
Oh yeah,
yeah. You know, and I'm not buying the future price. I'm buying what it is now. Like, what are the rents
or
here?
I've seen some of them, they base it on physical occupancy instead of economic
occupancy. Yeah, we had that with a property because I just had the GP meeting yesterday in the Carolinas, and they had quite a few. They stacked, you know, as you say, they stacked the property before they left, and we had a few evictions after that because a lot of them decided after the place closed, they weren't going to pay. You know, they gave them some concessions to get in there, and it was physical occupancy, wasn't economic occupancy. So that's a bit of an issue. That's a good tip to have everyone look out for, you know.
Yeah, but if you have like your guy doing the inspections, like, he can, first of all, you're going to just go through and knock on all the doors and figure out who's actually there. And then you're going to have someone go through the bank statements and
see where the actual mony is.
Is the money match the houses or the amount?
That's the thing. Does the rent roll match the bank statements?
That's what I'm saying.
If it doesn't, then you need to say, hey, well, I see you're missing X amount of money, so we're going to need to adjust the price and everything.
Yeah, or you're going to have to fix this beforehand, because I don't want to fix it.
Or you're going to have to give me
I'm taking a cut. Yeah.
You're going to have to pay, you know, at closing, give me the money for that amount of loss and everything.
Well, like when you're talking about the multifamily, it's based on net operating income, and if that net operating income isn't accurate, then you're basing it off of applying a cap rate to you a net operating
A
income that isn't
fictitious
accurate. And you're
number.
like,
Yeah, a
it's just like
fictitious number.
playing the Kansas City Chiefs in the playoffs. You know, it's kind of where they want to place the ball. It could be like where it actually is, or it could be like
Oh,
on the
yeah.
other side. Sorry, I'm not
Yeah, it's like it could, yeah, like any team always wants the ball ahead
Yeah.
where it is. But well, this has been really great. Is there any other recommendation you could have for other people that are just, maybe they've gotten a few properties and they want to maybe grow a little further? Is there any other recommendation you could make for them?
Yeah, I'll give you a couple tips, right? Just being like a non-resident. Buy stuff in an entity, like a C Corp, an LP, an LLC. Buy it in an entity, because then it's treated like an American entity. Buy it in an American entity.
Yeah.
Don't buy it in a Canadian entity. And because otherwise there's taxes that get taxed on to foreigners, right? So there's the thing called FERPTA tax. If you buy, happened to my parents' neighbor. They went and bought a property in Florida, and then, 10 years later, whatever, they're getting older. They were old, and then they got really old, and they're like, yeah, we can't fly anymore. So they decided to sell it, and they're like, yeah, they took 15% off of the sale price and just went right to the IRS. And
they take it off the top.
Yeah, right off the top. And the thing is, you can get that back. They just want you to file taxes, right? So they're going to take more than they should take, and then you file taxes and they'll fix it. But you're basically giving the IRS a 1.5-year loan for free, zero interest.
Yeah.
But the easier way is if you just bought that in an entity, then you wouldn't have any of these issues, right?
Oh, that's great.
So that'll save you like 15% right off the top. And like a lot of these things are fixable. Like if you're going to only own, like say you're buying a single property and that's it. Typically, if you're going to have a single structure to own that, single entity just to own that, as a Canadian, you don't want to own it in an LLC. You can have LLCs in your structure and they can own the property, but you need to have structure above that. For Canadians, the problem is typically income flows up. And if you don't have something above an LLC, because an LLC is a flow-through entity, it'll flow to your personal taxes. And so what'll happen is the IRS will tax you personally, and then Canada Revenue, they'll tax you corporately, because they'll say, oh, that's money from a corporation. You just got double tax. The thing is, if it went flew and you did personal to personal in Canada, there's a tax credit. So if you paid money to the IRS, you don't have to pay it to Canada Revenue. Same thing if you did corporate. You pay corporate tax, they see using a C Corp, and then you bring it back to Canada and they'll tax the corporation like no extra tax. But it's when you get this cross and you're doing one personal, business.
So you need some type of holding company in between or something like that. Just
either have a holding company or just own it in an LP, own it in a C Corp, own it in some other entity, own it in a trust. Just an LLC is one of those weird ones that gets tangled with the different laws in different countries.
Yeah, it's a unique thing kind of to the United States.
Yeah.
That's it's very useful for us as citizens and stuff like that, but it can get a little bit squirrely for you guys, foreign nationals and everything.
But if you do this wrong, because typically you talk to an American attorney or American CPAs can set these up too, but if someone sets up your structure and if they don't know any better, a lot of times they do set up an LLC, right? Because it's the most common structure for an American. And so you have this LLC. My first corporation was an LLC that I own properties in. And you really won't see the problem until you sell the properties, right?
Yeah.
So it's going to down the road. The thing is, you can get another CPA to fix that structure. Yeah. So you can do the check the box election on your taxes with the IRS and just turn your LLC into a C Corp or a different kind of structure, right?
Yeah, S Corp or whatever, I guess. Yeah.
Well, Canadians can't use S Corps. You have
S Corps has to be a C Corp.
Have to have all American partners in them. So it's one of those.
Did not know
a lot of the stuff, but S Corps is one of the ones that we just can't. Like it's the IRS, like America won't let us use it.
That's good to know, because when I speak with some of my guys and stuff, they'll need to know that. Well, again, this has been really great. If some people want to get in contact with you and find out more about what you're doing, how can they get a hold of you?
So I do a podcast. It's completely free, like all podcasts are, like this one is. But it's called Canadian Investing in the U.S.A. It's on everything. Or just go to glensutherland.com, one N in Glen, and it has links to coaching, to podcasts, to other podcasts I've been on. And once you send me a link to this one, I'll add it to the list there, and then you can hear me talk about different topics or whatever.
Yeah.
Or just also my email address is on the website. Reach out and I will answer. It will actually be me. I do not have a bot set up or AI. It will actually be me that responds.
Well, thanks so much for taking the time to be here with me and have a conversation. It's been a lot of fun, and we'll definitely be talking more.
It was great. Thanks so much for having me.
Well, this is the Yacht Captain Investor out. Thanks so much, Glen Sutherland. We'll be talking to you soon.